Peter, very good to see you. Welcome back, everyone. I'm glad we have a chance to talk today, Peter, because I want to talk about the recent market volatility. Concerns about a cooling U.S. economy led to a market rout recently, with the Dow down as many as 1,100 points. Stocks and treasury yields did pair some declines after service sector data came in better than expected. Of course, we know volatility and corrections are part of the capital market landscape, but I want to show you, of course, a map that we've looked at before, Peter, which is a look at the S&P, and this is the 1 month performance. So when we see this much red on the board and we hear those scary headlines, what should we be thinking?
Yeah, well, I mean, market volatility is an ever-present factor when you are investing in the market, in stocks, in mutual funds, and ETFs. You're going to experience some market volatility. And as for the contributing factors, it's always easy to pinpoint what those are after the fact, but you should always be prepared ahead of time by having a plan and understanding that you are only exposing money to the market that you can afford to and feel comfortable seeing sometimes wild fluctuations with. And it's kind of like a hurricane right out in the Atlantic. You need to be prepared for it ahead of time. And hurricanes, even, it's easy to see it a couple weeks out and then begin to get prepared. Market volatility can happen much more quickly and unexpectedly. And then, of course, with this recent instance, looking back, they have pinpointed some specific catalysts for it, like the fact that Japan raised interest rates for the first time in 20 years, and it led to Japan's worst day since the black market in 1987. And then it sort of cascaded because we are in a global economy. And then Japan kind of pulled back on their stance that they were going to continue raising interest rates, and markets began to rebound. But we never know the full implications or the exact reasons, even after the fact. And we certainly don't know the cause of upcoming market volatility. So in looking at that chart of the S&P, yeah, like 1 month, it looks pretty bad. But if you flip and look at the year to date, those colors change, and it has paid to be invested this year in some particular stocks very handsomely. And some of the best days in the market, some of the best months in the market, some of the best years in the market happen directly after some of the worst. So we expect to see volatility, but remember, being invested is a long-term time horizon type of endeavor. And markets have always not only come back from volatility and downturns, but surpassed previous highs throughout history. And we expect that that would continue if we are choosing to expose any of our money to the volatility of the market.
Right. And I'm glad we got to look at that year-to-date performance, because markets have been doing well this year.
Very different, right?
But, right? Yeah, very different. And of course, so it's been very strong because of tech. So was this correction in part related to the concentration risk that we've talked about before, where 82% of the movement of the market is due to 10 stocks?
Yeah, the Magnificent Seven or those 10 big ones, right? And that FinViz chart actually tries to visually show us the weighting of those mega companies compared to all of the others in the market. If you notice the size of the corresponding squares, that's essentially how much that particular stock or company contributes to the weighting of the movement of the S&P, basically their relative value as compared to the entirety of every company in the S&P. So when those behemoths, when those big squares move significantly, it moves the entire market. And so we may want to look at everything being cyclical, given a long enough period of time, it seems, in the market, that while those Magnificent Seven or those Big 10 companies have really brought the entirety of the S&P up this year, it may make sense to, rather than look at a weighted S&P, an equal weighted potential, because those smaller companies eventually are going to come back. Yeah, they have not contributed a whole lot to the movement of the market or the gains that we've seen thus far this year, but they've been more steady as she goes. And when volatility is present or presents itself, maybe that equal weighting across or more diversification would benefit those that are a little more risk adverse and not as comfortable with volatility.
Again, diversification is so important. You're not diversified if you are just investing in the S&P, as we've talked about before. So the question is then, how have well-diversified portfolios withstood this recent market volatility?
Well, the key is correlation, right? Is that where you have assets that all tend to move in the same direction simultaneously, is that truly diversification? And there's this 67, 68-year-old kind of theory known as the modern portfolio theory, which basically addresses asset diversification, saying, hey, you should have this much in stocks and this much in bonds or fixed income, this much exposed to the market and equities, and then this much that is a little bit more conservatively placed. But what we have seen over the last 25 years is that even that quote unquote modern portfolio theory, which is about retirement aged itself, has failed us. We have seen both the fixed income and the bond market and the equities of the stock market moving in a much more correlated direction, meaning at the same direction at the same time. And so it has not given us this sense of balance that it once did. So the true measure is asset location, and that you need to have some non-correlated assets or some form of protection for money that you don't want to lose, that it's not going to move in the same direction at the same time. And in this respect, there are savings and checking and money market and bank style interest bearing accounts right now that are producing a fairly attractive interest rate that would not be correlated to the movement of the market. Not saying that you need to have a large portion of your total assets and life savings, but that's an example of something that's not correlated. And then there are additional options and investment alternatives out there, anything from fixed products to buffered or defined outcome products, where you can lessen the degree of volatility and more precisely help to define your outcome, or at least the fact that you're not going to be subject nearly to as much volatility and velocity as well. The quickness of how those losses happen tend to scare a lot of investors away, making knee-jerk reactions, doing the wrong thing at the wrong time. And Erin, you and I were laughing beforehand that if you go to Google, or if you did in the days right following that big market downturn, and just begin to type in "should I," the predictive nature of the Google AI brain helps you to autofill, should I sell my stocks now? And that is kind of indicative and is a lean to how many people may have been thinking that or doing that. And again, you need to have a plan in place, because if you are not comfortable with the volatility, you may make knee-jerk reactions that are not in your best interest long-term. You should only have money exposed to the market that you are seeing, and that you are comfortable seeing that kind of fluctuation and volatility with. So maybe not the right time to just sell out your portfolio, but also knowing kind of where we are in overlaying present conditions with history, is that the months leading up to a presidential election do tend to see more volatility throughout history. And then the months following a presidential election seem to be much more stable. So again, it is time that we probably just need to buckle in and review and evaluate your plan, which is your preparedness for the future, and make sure that we're only taking risk with money that we are comfortable with and that we can afford to, and that we stick to that plan if we do see volatility thereafter.
Because just to underscore what you were saying earlier, if you had sold on August 5th, I think it was 2 Fridays ago, you would have missed that rally. You would have locked in your losses.
Right. And again, some of the best days in the market happen right after some of the worst days, and we have seen a pretty nice rebound since then.
So Peter, how can somebody get in touch with you so that they can work with you to create a plan so that they're not going to Google for financial advice the day of?
Well, you're welcome to be in touch, and having that plan is so important, something that you are comfortable with looking forward and saying, hey, this is going to work for me with the balance and with my personal comfort level. That's what we call the optimized retirement plan. And really, wherever you're at in your financial progress, it's good to have that in place, because we should be thinking about retirement throughout our working career, and certainly should have a plan on the doorstep of, or even once we are in retirement. It looks at income, investments, taxes, healthcare, legacy. Of course, what we've been talking about is that investments piece, making sure that you're comfortable with the risk that you're taking, that you understand it. And so if you'd like to get that review, analysis, and that plan, that optimized retirement plan put together, give me a call, 919-300-5886. 919-300-5886. You can also find our calendar online to reserve a time for a phone call or a consultation in person or virtually at richonplanning.com. That's what it looks like. It's my last name, Richon, at richonplanning.com, or email me, Peter, at richonplanning.com. Lots of ways to be in touch.
Great. Peter, thank you.
Always a pleasure, Erin. Thank you. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. You know, one of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k, or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings, and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookzone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.